All right. Welcome everybody to live valuation. Sorry, getting started a few minutes late. Some technical difficulties, but this time I swear it's actually not my fault. Apparently, AWS is having some issues, which is giving Streamlabs some issues, and that was giving me some issues. But anyway, we got it going. Today we're going to be taking a look at ticker VABA, Alibaba Group. Pretty well-known company. Doesn't necessarily need a huge amount of introduction, but obviously we're gonna be giving it one anyway. Hold on just 1 second. Double checking a couple of the stream settings. Gotta make sure. So many issues lately. But anyway, we've covered the company on the channel before, and it is a holding of mine, although I'm definitely been reevaluating it over and over again for the last few months. I definitely bought into it at a higher price point than I probably ought to have, on the assumption that its growth profile would continue. And well, my beliefs around the growth of the company as well as the markets in general has shifted over time. But we'll get into that. Taking a look at our watch list here today. This week I've been buying a bit more of Interfor as well as Smith & Wesson, as I kind of was last week. I also made kind of a off-plan purchase yesterday of a little bit more of Sandfire Resources because they were putting in their 10K here, or well, 10K equivalent, their annual report. They're an Australian mining company. And I've been really diving into the copper mining sector and decided that I wanted to add a little bit more to that position as well. But either way, we had the GDP numbers come out today, which was another decline in real GDP for the second quarter in a row. So a lot of people talking about whether or not that means we're in recession right now, and other people in politics or even in the Federal Reserve claiming that that doesn't necessarily mean that we're in recession, which I mean technically is sort of true. Technically, recessions are defined by the National Bureau of Economic Research, and they themselves for a long time have not necessarily always used the 2-quarter thing as a definition. That's just kind of the general rule of thumb. But the fact that unemployment has not risen yet definitely gives them reason to argue that it's not yet. But hey, that may change in the near future. I've been noticing that the initial claims have been starting to tick up for the last couple months or so as interest rates have been rising. They're still not very high up relative to a couple of year kind of scale, but it always starts relatively low. So we'll see where unemployment goes thereafter. Originally, I was planning to take a look at ticker BBWI today, and obviously Alibaba kind of took its place. So that one is very likely going to be what we cover next for the next stream, but I'm also taking a look at Microsoft, and also, like I said, Sandfire Resources will be putting their annual report out as well. So between the three of those are kind of what we have next on the docket as far as valuations around here. So before we get into the valuation itself, it would be really appreciated if you could give the stream a like. Liking the stream helps attract more viewers to the channel, and if you're not already subscribed to the channel, please subscribe. Subscribing to the channel will also help get more people to the channel, and it'll also make sure that you don't miss any of the streams that we do or any of the other videos I put out. And if you haven't already joined the Discord, find the link in the description below. Join the Discord. You can have discussions with the other members of our community, talking about the daily news, as well as discussing our ideas for investments and company analysis and other major investors in the market. So join the discussion there. So getting into Alibaba, it was founded in 1999, and obviously it's incorporated in China on the Hong Kong dual listing sort of exchange, but with the ADR structure in the New York exchange. Their home currency is in the Chinese yuan. They do report a lot of their numbers in USD, and so a lot of people actually do like to do valuations of them directly in USD. But whenever it's relevant, I like to use the direct currency that they themselves use for their operations, and that does happen to be the Chinese currency, and then we convert it back. We do have all of their websites here. The main website for commercial purposes, investor relations, as well as the SEC page where they put their foreign reportings. Their current CEO, Yang Zhang, was elected to be CEO in 2015, and he joined Alibaba in 2007, so he's been around longer than our entire historical time frame in the company, and he was actually charged for most of that time frame as well. So it's always a kind of a good thing, because it means we can kind of directly say that a lot of the results are his responsibility, so to speak. Obviously part of the internet retail industry. Top customers, a little bit of a broad thing to try to localize into a couple specific people. Same thing for the suppliers. As far as competitors, they have many competitors, but I mean, they list a few in their own annual reports for different things as well. I only really jotted down a couple major ones here, that being Tencent and Amazon, both being competitors in different ways, in different forms. And in some senses, you could argue that they're barely even a competitor of Amazon, but in other ways, they're very much a huge competitor of Amazon. So it kind of depends on how you look at it. In other sense, they're just a comparable company, but whatever. Reporting, the next reporter, this is obviously was a little bit off from the time frame. This was information from Yahoo from time before, so it's not actually entirely relevant at this point. They don't have any current guidance for the next year. They didn't provide that in their call with their letter with the CEO, which we'll actually get into for a couple other details here in a minute. The analysts on Yahoo, however, do have it guided for the next year, 7.3% annualized growth for the revenue. That's 44 analysts projecting for that. For the year thereafter, they are projecting to return back to double-digit growth, but for the 2023 numbers, they're expecting it to be single digits, which we're going to be keeping in line with our valuation as well. That's going to be relevant to our own projections. And then the EPS earnings analyst projection for 2023 is $7.72 per ADR. I'm pretty sure that's ADR. Maybe that was per share. Crap, now I'm not 100% sure on that. No, not per share. I mean per direct listing, not actually per share. I'm pretty sure that's ADR. They don't have any dividends, but they do have about 80 to 81 billion won in buyback authorization. Or wait a minute, wait. This is in dollar. This is fully correct. I think I have a conversion on their issue. I think, what was it? I mean, I have to go look for the, pretty sure they have it in here. Hold on just 1 second. Hold on. Buyback. Oh, did they not even put it in here? No? Jeez. My bad. Hold on a second. Buyback. What? Damn, okay, well, either way, that number I'm pretty sure isn't fully accurate. I'm pretty sure it's actually a little bit lower than that. I don't think it's 30% of their capitalization that they have authorized. So I'm pretty sure I have a mistake in there. I thought it was like around 10% or something, but I might be mistaken there. Anyway, 30% of their shares are held by insiders. That you can get that information if you look directly on the Hong Kong listing number itself, rather than directly as the ADR, because the ADRs are not specifically held at that kind of percentage. 18% is held by institutions, only about 1 to 2% being currently shorted. Same thing about the float, with a short ratio of 1.33 months, so nothing too major in there. 3-month average volume is 59 million or so versus the 10-day average volume of 46 million. So a little bit lower in the last 10 days. That's pretty typical for a lot of companies that we've been looking at lately in the more short term versus the midterm volume, but a little bit less of a distance between the two in this particular company versus some other ones. So getting into the company presentation here, there is a couple specific things I wanted to point out before getting into the actual financials of the company, which is that they have in their presentation they're here talking about how they have achieved 1.3 billion annual active consumers globally. And then they disaggregate the annual active consumers by different subsections here: China and international, and then China is separated into commerce and local commercial services. Now, in a lot of the previous financial statements, they actually give a lot of the same information, annual active consumers, for the China commerce section. They don't give quite as much information for the other sections in a lot of their past years. But the one thing that I find interesting is that in the most recent 10K, they basically hardly actually bring up this number at all, but they do have it in this presentation here. As I'm showing it right here, they have this little chart right here, and then in their what is it? In this particular spot right here, they talk about annual active consumers in this paragraph right here, and then also in the CEO letter, they talk about it. I'm pretty sure he mentions it one time as well. Maybe not. I could have sworn he did. Maybe not. Maybe it was only in that paragraph and then in that chart there. But in the previous 10Ks, they also used to use a metric MAUs, which is mobile monthly active users. And they would bring this up all the time, and they would usually have charts of both of those numbers next to each other, so you could kind of compare as the mobile monthly active users grew over time, the annual active consumers would grow over time as well. And then, like they said, they would usually have like a chart right below it where they would have both of these information. I find it interesting that in this most recent year, they're stopping showing the mobile monthly active users. And I'm not entirely sure why. And I don't have all the other 10Ks up in front of me to show you that they were giving that information, but I was actually building some charts around that for the revenue model that I built at the company, which is over here. And I'll be showing you guys all of that once we do all the projections for the company. But I actually do have the mobile monthly active users and annual active consumers by year from 2021 all the way back to 2013 for them, because they were listing it in their 10K. So I actually have the information right here. But I find it very strange and curious that they're not reporting it in the presentation anymore. And no, they didn't bring it up in the call either. I also searched for it in the transcripts. I don't really know why they're still reporting the annual active consumers in just this one little area here. But like I said, they don't even bring it up in the 10K. And most of that information that I got for this chart, I got them from the 10K. So that's why it's or the 40F, I guess I should be saying, not 10K, but the annual report filing. So I don't know why that information isn't there anymore. But anyway, we'll get to the actual revenue model in a minute. I don't want to talk about that exactly just yet. But we will take a look at the financial information, and starting with the segmentation as we typically often do. They have their company obviously separated into those different segments as we were showing: the Chinese commerce, the consumer services, and international. But in their 10K, they also separate out by different business types. And I prefer using that method when building my segmentation for the company. And so they have customer management services, membership fees, logistics services, cloud computing, sales of goods, and other. Those being the kind of types of services that they provide. And I thought that made more sense to disaggregate the revenues by that. So customer service management, that makes up 45% of the revenues. Membership fees about 4%. Logistics services about 8%. Cloud computing about 9%. Sales of good about 30%. And other about 4%. So altogether, that gives me an unlevered weighted beta of 1.09. I'm using the global indices for all of these information since it's a foreign company. That's what I typically do. Sales capital ratio expectations, we end up with 2.21, and adjusted net margin expectations, we end up with 9.45. Since we're disaggregating it by service type rather than by the actual business as it might separately operate as an independent entity, that kind of means that the sales capital ratio and the adjusted net margin information is not going to be as useful for this valuation. The reason why I chose this form of disaggregating it is because I thought it worked better for the beta itself specifically. So, and I usually lean towards that. It's like if I have to choose to make the beta more accurate at the cost of making these assessments less accurate, I'll do that, because I don't really actually use these for the valuation. I just use them for a comparison to like think about where they stand compared to their industry, whereas this number actually goes directly into the valuation. So I try to make that make a number that I think makes the most sense. Anyway, just a digression of why I'm probably not going to pay that much attention to these two numbers. But anyway, so with the disaggregation by geographic location, 80% of the revenues come from within China, about 20% coming from outside of it, and basically the vast majority of their assets are in China itself. So I just have that as is. That gives me in a updated ERP of 6.71, adjusted for the debt to equity ratio, which is about 67%. If you take all of their debt into account, which is 123 billion won at about a 4% interest rate and 13-year weighted average maturity, which is a pretty good interest rate and a pretty nice long maturity. So good for them for having a pretty decent capital structure. I wish they had like twice as much debt at that level. However, it's not a very large amount. As we said, 6 to 7%. I could probably do with pumping that up to like 10 to 15%, I think. But either way, that brings the levered beta up to 1.15, and that brings the cost of equity up to 10.51%. So a pretty decent cost of equity, but altogether it could be worse. It's not too bad altogether. And like I said, I like their debt structure overall. So we can take a look at their financial history. Overall, we have their financials going from their fiscal year 2013 up through fiscal year 2022, which is how they calculate the numbers. That's the 2022 year that just ended. So they went from 34.5 billion won up to 853 billion won in the 10-year period. So huge, obviously dramatic increases in revenue. For the first 5 years, it averaged about 48 to 49% on a compounded basis. So pretty insane first 5 years. Second 5 years, it's compounded about 40%, so a little bit slower, but still very significant growth in revenues. And obviously, that's really the real question, is where people think the revenues are going to go in the future, which is another reason why, like I said, I myself got caught into buying this stock at a much higher price, because for example, the real reason the valuation has been crunched down is not even so much that necessarily its future has been decimated per se, but because all of that future, all of those earnings and revenues are in the future. That means that when the discount rates have been going up dramatically over the last 6 to 9 months, as they have been, then that means all of those earnings get discounted backward at a much smaller rate. And so really, that's just what happened, is that's why you have to buy companies at a margin of safety, because you never know when the market dynamics are going to shift that discounting effect around pretty dramatically. So anyway, the digression on that fact. Taking a look at the gross margins, you can see that for the first 5 years, they averaged what was it here? Switch to the average 68 to 69% for a gross margin, versus the next 5 years they average about 45%. So you can see there's a huge downward shift in the gross margins. That does have to do partially with the shift in their business, as they've moved from pure commerce towards a little bit of a mixture of cloud computing and other factors, logistics, and all the other things that they're kind of working on, their other side initiatives. So obviously that's had a little bit of a crunch down on their gross margins. We can kind of move down the line to take a look at what that's done to their overall profit margins, which they have pretty significant amounts of R&D. So using the R&D capitalization form that I use, that means we can't really pay too much attention to the first 4 years or so of the margins, because they don't have the capitalization going on as in full effect. So this is really the total amount of margins that we have sort of to look at. If over this entire time frame they average about 27%, we see for maybe the first 3 years of that section they average about 31%, versus the next 3 years they average about 23%. So downward shift in the margins. And at the first year, which is still kind of at the tail end of that first 5 year range with the higher gross margins, you can see it was at 34%, moving towards maybe about 25%. We can maybe discard the outlier here for that particular downward shift in thinking. So either way, about a 10% downward shift in the adjusted net margin, which goes in line with a pretty significant downward shift in the average gross margin over the same time frame, roughly speaking. Now, like I said, I kind of just tossed that 9 to 10% margin we had in 2022 out as a little bit of an outlier for that particular thought experiment right there. But we are not going to ignore the fact that they had a very significant large charges in 2022. Both coming from charges from the government, as well as write-offs of larger investments that they had done previously. We're definitely going to be taking these things into account. For example, I am using this as my base year, moving into the margins for the future. We haven't discussed what type of margin I am projecting for them for the future, but either way, moving forward, I am thinking about this most recent year as a base and then allowing the margin to grow into it, rather than say using the 3-year average, which is 22-23% as a base, which would suggest that their margins would bounce back very quickly in the next year. I'm suggesting that there's a good possibility that they don't actually bounce back in the next year that quickly. Instead, they kind of have to slowly creep back up. Maybe there's another couple charges here or there, or a couple more write-offs here or there. But I do think in the long run, their margins will move back up over time. Where to? We'll get to that once we get into the future projections part. But like I said, so that they can kind of think about the base year as more of where I think the margins are going to be in the short term versus in the long term. So I am thinking in the short term, we very well might see some pretty low margin years, though it will still move upward on that. So also keeping in mind that kind of base year effect way of thinking, and doing the same thing with the margins, I'm using the 2-year average as my base year, rather than just allowing my revenue growth, which again, with the growth rates that I'm going to use, we'll get into that in a little bit. But I am using the 2-year as my base. So you can see what the changeover in 1 year is that if I use the 1 year of my base, it basically says that the projected revenue I have growth for the next year is about 20% or so. If I have the 2 years as my base, it means that the next year is actually only about 10% or so, which, if you'll remember, the analysts were projecting about 7.3%. So it's kind of roughly in line with that way of thinking, that the analysts are seeing a lower percentage of growth in the short term, and then maybe a return to growth in the future, where to, again, we'll get to that. So I do have some kind of sandbagging essentially for the 2023 numbers, partially because of the economic slowdown that I'm projecting for a lot of companies. This is kind of my way of simulating that for Alibaba, though admittedly, I'm doing a little bit less of it for them, because I do think that even if China goes into economic slowdown, I think that really just puts Alibaba into a position to kind of like stand their ground while some of their smaller competitors might even be going out of business during the situation. So while they might not be able to expand against some of their larger competitors, I think they will be able to perhaps be able to hold their ground better against their smaller competitors better during that type of dynamic. So that's just my own personal take on potential slowdown in China particularly. But we'll get into actual projections for that, like I said, once we get through all the financials. So free cash flows to equity, we can take a look at them. For the first 5 years of our projected period, they had an average free cash flow to equity of 91 billion won or so on average. And the total amounts that they paid out to the shareholder is in fact not a payout to the shareholders at all. They were actually just issuing about 4.4 billion won in shares during that time frame per year. So no overpayment, that's for sure, because they weren't even paying at all. They did start paying in the next 5 years, however, but not as nearly that much. They averaged about 207 billion won per year that they could have paid out to the shareholders for the next 5 years, the last 5 years. And the total amount that they did pay out to their shareholders during that time frame is actually still negative, about negative 3.9 billion. So yes, they actually did start paying out their shareholders pretty significantly in 2022, but because of the fact that that's really the first substantial year, it doesn't even take over the pretty substantial negative issuance that they had even in 2020. So Alibaba only just started paying out their shareholders, but they are starting to pay out the shareholders. And as we had discussed, they do have a buyback authorization, though the calculation I think I had on it going from the, because that's what my issue was on that calculation there, is that this was supposed to calculate the reported USD authorization amount by the conversion number, but I think my currency conversion was screwed up there. So whatever. Well, like I said, we bypassed that part. So moving down to the returns on invested capital, we can see like how these huge cash flows actually done against their capital base. So those were some really large numbers, but again, they were also in Chinese yuan. How does it compare to their overall capital base? Well, overall capital base for the first 5 years, and returns thereof, returns on invested capital ended up being 35 to 36%. Now, the returns on invested capital end up suffering from the same effect that we were talking about with R&D capitalization, where you could argue that really only the most recent 6 years or so are actually relatively accurate in terms of the returns. So maybe we don't pay attention to those numbers, and we actually only pay attention to these numbers right here, which end up giving us about a 13% return on invested capital number against, for example, this was these years in the cash flows, which were actually 129, 130 billion won or so, which for comparison sake, for anybody's wondering, that ends up being like 50 billion. It's about 6-to-1 ratio of $1 to dollar for anybody who's not super familiar with that. So whatever. Anyway, so 13% for the returns on invested capital for this 3 years, comparing it to the next 3 years, which are the most recent three, ends up being about 8% or so, which of course does have this outlier year of the only 1% in the 2022, but hey, that's part of the calculation. If we're looking at the 5-year average, it ends up being about 9 to 10%, which is maybe a pretty good representative number of the type of returns on invested capital they've had in the last time frame or so, taking into account a little bit of an outlier year, but also some higher of the teen years. So pretty decent, I think. Moving down to the balance sheet itself, while this is one part of the Alibaba that's definitely a pretty great aspect, I would say, is that their balance sheet is pretty spectacular. Obviously, there's a lot of questions about just how available, I guess you could say, a lot of the assets and the equity therein are to the actual shareholders, including like the foreign shareholders. So a lot of people have argued that the cash may not be as large, so to speak, as it really is, because a lot of that cash might essentially be taxable at whim by certain governing authorities in China itself, as we've kind of seen over the short term. So, but that's neither here nor there. Like I said, we kind of are taking those things into account in our margins, so to speak. But either way, regardless of that fact, they still build up huge amounts of cash. 190 billion won currently in cash and equivalents, 265 billion in marketable securities, so that's also pretty relatively liquid, large amounts of cash, ending up with 639 billion in total current assets, comparing that against 384 billion in current liabilities, the amounts of which that are payables. The payables are only about 22 billion, current debt being pretty negligible. If we add on the long-term debt onto that, we end up with, what is that, 545 or so billion So the total current assets can pay for all of the current liabilities and the long-term debt. In fact, they can pay for all of the liabilities. So in terms of just the balance sheet on itself, the balance sheet can basically be entirely paid off in just the short-term assets, making the entire operating assets effectively free, or not effectively free, effectively being just at the cost of the shares themselves. So, you know, not in market terms, it's not a net, but in balance sheet terms, it effectively is. Moving down to the PE ratio, this is also affected by the R&D capitalization, so we're not really going to talk too much about it here since we really only have a few years of relevant information for it. But if we do take at least a look at those few most recent years or so, you can argue that it still is trading relatively cheap now compared to where it has at least for the last few years, but that doesn't take into account interest rate changes and other factors like that. Though it's worth noting that the Chinese bond interest rate hasn't changed nearly as much as the American bond has, which is the Chinese bond that's relevant to Alibaba Group since their cash flows are in Chinese yuan. But anyway, sales and capital ratio, we can take a look at that one. This is another thing that has also been somewhat affected by R&D capitalization. So we will only look at the most recent 6 years. If we take a look at them, however, they average about 0.62, 0.63, and that effectively means that they earn 63 cents or so in new revenues for each dollar of capital that they add to the business. So it's not a very capital efficient business, which is pretty common for a lot of the internet retailers that actually do the distribution, logistics and stuff like that. Like, it's pretty expensive for a capital base. Not to mention cloud computing tends to be pretty expensive on that end as well. So they're in some pretty capital intensive businesses. Nothing too surprising there. We can see that they are at least starting to trend a little bit upward, and particularly trending upward over the kind of period that I said was most relevant to our numbers. So that's at least a good trend for them. We're definitely going to be keeping that in mind in our actual projections moving forward. And that kind of does back up with the fact that they had relatively high margins. So typically speaking, if you have high margins, it's because you have a capital intensive business, and that's essentially protecting your margins from competition. And if you have a low capital intensive business, you typically have low margins because it's easy for competitors to get into your business. So these things are usually a little bit of a mirror of each other. So anyway, we'll start to get into the future projections, including my model for the revenues of the company. But before we do, it'd be really appreciated for anybody who's watching at this point to please give us a like. We need more likes to attract more viewers to the channel. And if you like content like this, giving us a like would help convince YouTube to show it to more people, which will help incentivize me to make more content like it. If you're not already subscribed to the channel, please subscribe. Subscribing will make sure that you get notifications whenever we go live, as well as whenever I put other content out there. And we would love to have you watching all the time. Not to mention, you could join our Discord, which the link is in the description below. Join to be a part of the discussions that we have there. So anyway, getting into my revenue models that I've built for Alibaba. I actually built two separate models. One of them that's meant to be a very kind of conservative, somewhat more pessimistic model, based off of certain macro factors, and then one that's a little bit more of an optimistic model, based off of kind of growth projections based around the company itself, and their own internal metrics, which was the mobile monthly active users and the annual active consumers that we talked about here. So I have a lot of information here, and I actually have a lot more information off to the side that is kind of going into some of the calculations here, but I didn't really have it super cluttered. So this is the stuff that's relevant, I think, to kind of explain it as a summary. I have China's GDP here by year, and the year-over-year numbers are in this column. Their population is listed here. And then I've also made an adjustment to their population based off of some well-known discrepancies in the data due to demographers and political strategists, and a lot of other experts are aware that there was kind of some issues in their data that the Chinese government essentially claimed to have found about 100 million excess births that they said that they had not accounted for previously at some point about 20 years ago. So I'm basically adjusting backward for that. You might say, oh, well, that sounds a little kind of strange and conspiratorial to include in your evaluation, Derek. Why would you do such a thing? Well, actually, me doing that helps them because of the way in which I'm doing these calculations, because I'm building this projection based off of their consumer spending per capita. So by lowering their population number, I'm actually increasing the consumer spending per capita, which increases the correlation that it has with the revenue. So funnily enough, this strange thing where it sounds like I'm I'm being extremely skeptical of the Chinese government or something, ends up helping with the correlation here. But anyway, I digress. The point is that a lot of people believe that the Chinese population is actually probably about 100 million or so lower than the current accepted published numbers by the Chinese government. So I kind of made an adjustment for that in this column here. Then there's the consumer spending that the Chinese government reports, and that distributed by population, we get to consumer spending per capita, and we get the growth rates for that. The growth rates for consumer spending per capita and Alibaba revenues. And then with Alibaba revenues, we also have the mobile monthly active users and the annual active consumers. So moving down here to the kind of two models that I built, other inputs that go into the assumption, the average population growth by year between the various years that we had here ends up being 0.57. Which some of those growth rates were actually a little bit higher in the past relative to the lower ones in the more recent years. So that's another way in which I'm actually being a little bit more generous to them by allowing the kind of longer term average to be the number that we're using for the projections. And then the 10-year Chinese bond, which is currently about 2.8%, which, like I said, I use that as part of my valuation to begin with. That's the risk-free rate and the projection for long-term growth. But it's also, because of the fact that it's a projection for long-term growth, it's considered a proxy, the nominal yield for GDP growth. So I'm using that as part of my assumption here and therein as well. And then the ratio of the correlation of revenues of Alibaba to the spending per capita ends up being 82%, which is pretty strong statistical correlation. So if we essentially use a projection based off of those factors, I end up with an assumption, like I said, a very conservative assumption based off of population growth of China, and assuming that Alibaba continues to essentially grow their revenues in line with it, that we end up with 890.6 billion won as the 2027 Alibaba revenues. And again, this is supposed to be a very conservative number. So yeah, you're like, oh my gosh, that's basically no growth. It's supposed to be an extremely low number because, like I said, I also have a very optimistic model. Oops, I didn't mean to jump off the side here. I also have a very optimistic model over here based off of user model growth, where I take extra assumptions of the average ratio between the monthly mobile active users and the annual active consumers of about 88%. The correlation between the mobile monthly active users to the population ends up being to population growth ends up being 65%, which is not as good as 82%, but still pretty decent. Annual active consumers to mobile monthly users correlation ends up being 85 to 86%, and then Alibaba revenues to annual active consumers correlation ends up being 72% or so. And then the average between all of those correlations ends up being about 74-75%, which again, that's a pretty decent statistical number to get for a year-over-year growth rate correlation between these different types of factors. And you might say like, well, why are you using these different correlations? Like, it feels strange to use this like chain of things that are correlated against each other. And it's like, well, if you look between it, if you line them up any other way, you end up with like negative correlations or like statistically insignificant correlations close to 0 or less than 25%. So like the fact that I end up with these like relatively large numbers in the range of about 75% or higher is actually pretty interesting, pretty neat. I think it's pretty relevant. You could also argue that I could have maybe found some different data to come up with some slightly better correlations. I did think about, for example, this mobile monthly active users. I don't know if you noticed, but the word mobile is in there. So like maybe if I had gotten some information on like telecommunication penetration into the populations of China or things like that. So if I'd gotten some other data, I might be able to have gotten some stronger correlations. But either way, I do adjust these assumptions for the level of the correlation. That's what I mean by error adjusted. So I am adjusting for basically how strong the correlations are, regardless of that fact. But anyway, I digress. Using this user model and those correlations that I just talked about, I end up with a second separate, much more, like I said, optimistic model, error adjusted 2027 revenues of 3.8 billion or trillion won. Which again, divide by 6 if you're trying to think about what that is in USD. So yeah, that's like 600 billion, I think, in USD or so. The average between the two end up being 2.3 trillion. So these are going to be my revenue assumptions that I'm going to be using for my model. This is going to be my worst case scenario. This is going to be my best case scenario. And then this is going to be roughly my my analyst model, which is really just the way I'm tilting the model towards a certain end. Okay, so those are my my revenue assumptions. If I come up to the top, take a look at those revenue assumptions, I try to put them into the model. As I said, I'm using the 2-year average as my base, which means I'm essentially simulating the growth starts at a slow pace of around 10% in the next most recent year. But then by the end, they're going to accelerate towards a worst case scenario of 866, which is a bit lower than the number I had in there, to up to 3.9, which is a bit higher than the other number I had right there, which gives me 2% to 38% as a range for my revenue growth. And then, as I said, 2.3, 2.4 was the number I was going to lean towards. That ends up being 25%, which ends up right here. And that gives me an expected revenue growth rate of 18 to 19% per year for the next 5 years for Alibaba. So with that revenue, those two separate revenue models all together, this is the revenue growth rates I end up with. As I said, I believe that they're going to start off at a slow pace of around 10% for the next year, but then it's going to accelerate over the next 4 years thereafter, making the overall 5-year period about an 18 to 19% growth rate. The probability distribution that I'm going to be using for this model is shown here, which has a pretty significant amount of it weighed towards the middle median model. And then I do have twice as much weighting towards a little bit more pessimistic way of thinking than towards a more optimistic way of thinking, which is partially to sandbag some of these very exuberant expectations that are in here. Because that is some pretty huge growth expectations. I am essentially assuming that they're going to 2.5 times their revenues on an expected basis over the next 5 years, which obviously they've done much more than that over the last 5 to 10 years. But even so, like I said, I've already kind of been burned on this a little bit to a certain extent. And even so, obviously with these projections, you can see my valuation still isn't coming out to be that hot. But we're getting into the other assumptions that get there. So coming down to the margins, this is where things get a little bit more tricky. As I said, I am assuming that they're going to essentially have relatively low margins in the short term. On an expected basis, it's going to be around 11 to 12% in the next year is basically what I'm saying. I can see that that's just maybe not what happens. I can see that maybe next year their margins are 25 to 30%, and everyone's like, oh, yay, Alibaba's profitable again. But then maybe it's the year after that where suddenly they have a 10% margin again, you know? It's like, it doesn't have to be in a linear line. So I can see this being a very volatile thing where China leaves them alone for a year or two, lets them be profitable, and then hits the investors with a big fat multi-billion-dollar fine or something a couple years later. You know, it doesn't all have to be in a consistent line when these things happen, or when the write-downs on their other investments come. You know, it's like, so just because I'm sandbagging the near term doesn't actually mean that you have to think about it as happening in the near term. It just means that over this kind of projected time frame, I think that the average margin is not going to necessarily be the terminal margin. It's like it's going to grow towards the terminal margin, but during the time frame, it's not going to be that terminal margin. It's going to have to go towards it. It's like right now it's about 10%. In the end, I'm saying it's going to get to around 21 to 22% on a range of 10 to 30%, lean towards 25 for anybody who wasn't noticing that that's what the assumptions are. So I think it'll reach perhaps around a 22% terminal margin. But I do think that the average margin for the next 4 years could be around 15%. So that's kind of the point, is that it's a little bit of a mixture between those things. Like, I do think in the long term, we're going to get back up to those fat margins, but we might have a little bit of a rocky road to get there. So coming down to the last of the assumptions that are relevant for the valuation, we do have the sales capital ratio. As we had seen, they have kind of averaged this 0.63 to 0.7 kind of range, and it's currently 0.71, and it's been moving upward for the last 4 to 5 years on a pretty consistent basis, which is good. And so for that reason, I do feel reasonably confident to kind of have it lean upward. I do have it ranging from 0.35 to 0.9, and then lean to 0.7, and due to the other assumptions further up in the valuation line, that gets me an expected ratio of 0.83. So that's essentially what we see here, is that we see them kind of keeping on a current capital basis this range right here, but due to the other factors within the valuation, they actually would pull their expected ratio upward in line with the kind of upward trend that we were already seeing for them. The only other assumption that's relevant for coming up with the terminal valuation, for the most part, one other kind of addendum detail to address, is that their debt to equity ratio. They currently, like I said, have about 6 to 7%. I have assumptions of 0 to 15%, with it leaning towards 10%. And that gets me an expected ratio of about 8%, which you, depending on how you configure these numbers in here, adding more debt actually does help their valuation in a lot of ways. It depends on where you kind of place it. And they have a lot of wiggle room for it because they basically have 0 default risk. It's like super low default risk because of how much cash they have on hand and how low the debt to equity ratio is and how good their interest rate is. It's like they have zero risk of default. So the idea of them taking on a little bit more debt would probably help them more than it would harm them. But they're not really in a position to likely do so. They've never really had huge amounts of debt. They've usually always had huge amounts of cash on hand. They've never really taken on more debt when clear that the taking on more debt would be the faster way for them to help grow their business. They've issued large amounts of equity rather than doing the debt, even though it's costly to their company. As we showed before, the cost of equity they have is 10.5. Their cost of capital is about 10. The reason why is because they have almost no debt. So basically, their cost of capital is almost the same as their cost of equity. If they injected more debt into their company, which they get debt about a 4% rate, they would have a cost of capital lower. So they could lower their cost of capital probably by increasing a higher debt financing mix. The debt financing mix increased risk to their company, but like I said, there's such a low risk on those types of categories of risk that it feels like they could probably afford some wiggle room there. But their history has shown me that they're very hesitant to do so. And so I'm very hesitant to assume that they're going to do so. So that's why I'm only assuming it goes up to about 8%, whereas in a company that was at like the levels they're at 6 to 7%, I might assume that they go up to 10 or 11%. I might assume that they increase their debt dramatically or their market cap adjusted dramatically accordingly. So I'm not actually making those assumptions for Alibaba because I do think that their corporate governance is likely to keep them from issuing more debt comparative to other companies. So with that, that's basically all the assumptions that goes into the company, except for one final kind of addendum item, which is somewhat of an elephant in the room, depending on who you're talking to about Alibaba, which is its ADS ADR share structure and a lot of the concerns around it. The fact that it's effectively kind of a legal loophole of in regards to the actual laws surrounding corporate ownership in China for Chinese companies to have put their companies listed in the Cayman Islands under these depository structures for foreign investors to invest in their companies. And then there's a lot of concerns surrounding trade dynamics with the US and Chinese governments and the trade war they're in, and a lot of concerns with each other politically about how likely you think it is that maybe the Chinese government will decide, you know what, we actually want Chinese companies for Chinese investors, and that's it. I don't necessarily think it's a super likely chance, but I also think that it's irrational to invest in Alibaba without having adjusted for that chance regardless, because of the fact that the market itself perceives this as a serious risk. So I have essentially put this little box in right here and have it adjusting the present values, which then adjusts the future values and then adjusts the expected returns thereof. I can kind of move it up and down. If I bring it to 0%, you can see that it actually makes them jump up about 5% or so. It increases their situation a little bit. I had it at a 5% risk. That's just kind of an arbitrary number I chose to select. Another person could easily say they think it's a 20% risk, and then that would adjust it accordingly. That's just, like I said, an arbitrary thing I chose to put in here as part of the valuation. So with that gets me my final valuation right here for Alibaba, which I will say, as I said before, with the ADS structure, as well as a few of the other factors I put in place here, there's various ways in which I'm being kind of conservative towards the Alibaba in a way that you could argue I could just ignore those features if I think that the long-term value is still there, and the ADS structure being part of it. So you could argue that I should actually put a 0% here, and that I don't need to sandbag the revenue expectations for the short term, and I just need to focus on where I think the revenues are going to be in the long term, which means I would also have to adjust these assumptions here a little bit. So you can make a lot of assumptions about the kind of ways in which I was sandbagging some numbers in here to deal with short-term concerns. Basically, it's like the margin, the margin basing, the revenue basing, and the ADS structuring concern. You could argue are all short-term dynamics that I'm worried about. And so those short-term dynamics, if I erase all of them, get me to actually find that Alibaba's a little bit undervalued by roughly around the same amount that I was saying it was overvalued, or so, a little bit more than that. But so keeping in mind with the closure of this valuation and the summary as like I stated, you could think in your own head about the fact that these factors do have this type of an effect on the valuation. It's just something to keep in mind. As I said, everybody has their own ways of thinking about the company. These are all of the details relevant to the way I'm thinking about the company and the way I'm going to choose about investing in it or not investing in it moving forward. With that, I'll ask again, anybody who's watching at this point or is just watching on the replay, please give us a like. It'd be very appreciated if you would like the stream. Likes, more than most things, convince YouTube to show my content to other viewers, and more viewers will be able to attract more likes and a nice little circle that'll move upward and hopefully get us more subscribers. And if you are not subscribed to the channel, please subscribe to the channel. And as I've also said a couple times before, consider joining the Discord, the link of which you can find in the description below. So the Alibaba, the ticker BABA, at least for the ADR, not US Treasury, the Chinese 10-year Treasury currently selling at 2.8% or so. Mature market equity risk premiums I currently have 5.72%. I come out to a discount rate for Alibaba after adjusting for company specific idiosyncratic risks of 10.51%. They do not have a dividend. As we said before, they do have about I think it was 50 billion in USD current authorization. However, which, as I said, I'm not 100% sure what percentage that is, because my my calculation thing I think was off on that. But whatever, I digress. 5 years ago, they had sales of 158.2 billion won versus 853 billion in the most recent year, which is sales growth of 40% per year for the last 5 years. So pretty insane sales growth. Sales to capital ratio for the last 3 years on average has been 0.68 versus, again, industrial expectations of 2.21. But as I said at the start of the stream, the industrial expectations for the sales to capital ratio and the profit margins are probably not super accurate. As I said, when I'm deciding between making the beta calculation accurate or making those two more useful, I will bias towards making the beta accurate and just choose to ignore these factors when relevant. But it is worth noting that the dynamic I usually see within companies for these factors is still relevant here, which is that if you have a high sales to capital ratio in the industry usually has a relatively lower profit margin. And if you as an individual player relative to your industry have a low sales to capital ratio, you very possibly, assuming you're a decent company, have a high profit margin relative to them as well. Which obviously the most recent profit margin is not very high relative to it, but as we've seen, that's more of an outlier year in and of itself. But anyway, I'm getting digressed again from the valuation itself. Returns on invested capital for the last 3 years on average has been 9.73%. The debt to equity ratio currently about 6.65%. Oh, hey, Nukit, late again. Well, hey, late is better than never. We appreciate you as always. Default risk in the most recent year, it says 1% here, but it's actually should be like 0.69% because it is basically negligible at the lowest level it possibly could be, effectively zero because of the amount of cash they have on hand. And then profit margins in the most recent year, as we had already discussed, we're using that as our base effect because of expected future charges, 9.6%, which gave them profit of 81.982 billion won. They're currently selling for $100.37. That is in USD. It's worth noting that the actual share prices are in USD. That conversion has already occurred on this end of it, even though all the rest of the numbers are in Chinese yuan. The probability distribution that we're using for the company is pretty heavily tilted in the median case model, but we also have twice as much excess weighting towards the more pessimistic second model versus the more optimistic fourth model. Either way, that gets us a revenue distribution of worst case scenario 877 billion won to a best case scenario 3.9 trillion. On expected basis, we see about 2 trillion or so, which gets us sales growth of effectively flat to around 36% as a range. On expected basis, we see about 18 to 19% per year compounded. Sales to capital ratio on an expected basis, we see about 0.83. Returns on invested capital, we see about 17 to 18%. Debt to equity ratio, we see about 8.25% with a default risk of 0.53%. So basically meaningless amounts of default risk. As I was saying kind of before, they could probably easily double their debt to equity ratio and it would probably actually help their valuation. Profit margins, we have a distribution of 10 to 30%, leaning towards 25, and that gets us an expected value of 21 to 22%. Which gets us profit distribution expectations of anywhere from 86 to 87 billion won to possibly 1.1, 1.2
billion won. On an expected basis, we receive 438, 439 billion. So pretty significant profit expectations, as we had already talked about, compared to the very most recent year of profit, which is obviously at the 9% profit margins, which is a bit of an outlier. More typical profit margins is easily about double the most recent profit margins, or even higher than that, double to triple. So obviously comparing the expected profit margins to more of like a double or triple of this most recent year gets you an idea of just for how much they may be growing over this time frame. But either way, pretty significant growth expectations in the profit over the 5-year period. Using the discount rate that we came up with across all the various model expectations, we end up with a present value of $91.67. That is, however, after, again, as I already discussed, adjusting for an implied 5% chance of the ADS ADR share structuring being canceled over the 5-year period, and effectively them being relisted only to Hong Kong. That would be what that would mean. And since this is for the BABA structure, that is what it would be. If you did a valuation for simply the Hong Kong share structuring, you could remove that, and under those assumptions, I would argue that BABA would basically always trade at a small discount to the Hong Kong listed shares under this risk adjusted assessment, as well as there would be some other discount or premium factors having to do with currency liquidity, but that's a whole arbitrage discussion in and of itself. Either way, we have 5-year forward value targets unadjusted for dividends that they could choose to pay out during the time frame. A worst case scenario of $16.54 to a best case scenario of $553.06. Pretty wide range there of expectations. On an expected basis, we see $151.02, which compared to the current share price gets us an implied return of $8.51, 8.51% per share. Jesus, mixing up my terms. First I put it in dollar terms, and then I say a percent per share. I don't know why I'm so tongue-tied today. 8.51% per year for the next 5 years. So yeah, not super enthusiastic about Alibaba as much as I was in the past. As I said before, it's kind of funny comparing it to my previous evaluations for Alibaba, because in some senses I've gotten a little bit harsher in some of the expectations, but in other ways, not really. Like my profit margin expectations have trimmed down a little bit over time. I feel like one of my earlier evaluations, it was probably closer to a 25% expected margin. And then my sales capital ratio and debt assumptions, those haven't really shifted around that much. And sales, I've probably lowered my sales expectations a bit too. I think it was closer to 25%, and which has a huge effect. But honestly, the big factor that has really destroyed Alibaba's valuation is the discount rate, as I was talking about. It's the fact that, frankly, equity risk premiums have climbed so dramatically, and as have volatility based market risk measures. And so as a result, the way we're discounting all stocks have just increased dramatically. And also, you could argue that the market wasn't really pricing in that risk adjustment for the potential concerns related to the ADS share structuring. As I had also kind of talked about prior to doing the final summary, you could argue against some of those more pessimistic or conservative factors, like the 5% there, or using a 2-year average as the basing to kind of simulate a roughly 10% or even lower revenue growth in the most recent year and then accelerating thereafter, or the same thing with using the most recent margin as a base and then allowing it to grow in the 22% margins. So there's multiple ways in which I'm being a little bit more conservative over the near term 1 to 2 years for Alibaba, and then allowing them to grow back into strong profitability and growth over time. But you could argue that those factors are irrelevant, but that's just the way I'm going to value the company here. So as I've kind of also talked about on the channel a few times before, I did buy into this stock pretty significantly, and I've been down on it pretty significantly. And I've talked about in my portfolio update video that I did a month ago, as well as just kind of other random mentions here on the channel. I have trimmed back that position over time, and I trimmed back a little bit more this week as I was kind of completing this valuation. And I probably will continue to trim it back, because it does look like it's overvalued according to my assessments. As I had shown, if you take off all 3 of those kind of conservative factors, you do find it to be slightly undervalued, but not that undervalued. I ended up finding it to be like 5 to 6% undervalued if you took away those specific 3 conservative factors, but then left all the same endpoints in place, roughly speaking. And so shifting it from 9% down to 6% up is not that big of a difference. You know, it's like that's a very small margin for error in my opinion, which means that, yeah, it definitely means I needed to trim Alibaba down in the portfolio, because it was like my number 5 position by money put into the portfolio. So it is down now. It is down more to like I'm not sure, it was like 8 or 9, position 8 or 9 or something like that. I'm not sure. I'm not necessarily in a super rush to sell out of the entire company, because like I said, I do think that if you ignored those short-term factors, there is some little more upside. So I feel like maybe over the next month or two, I could see it performing relatively well compared to some other companies, maybe. But it is on the short list of companies that I would probably sell in order to get funds to put into other investments, which is something I'm kind of constantly always making decisions about. You know, you have to decide, well, I have money in this company over here. Would I rather put more money into another company over here instead? So that kind of completes the valuation of Alibaba for today. I did pop back over here to the watch list. As you can see, this kind of is in front of us here. If you see where Alibaba is on the watch list, I did have it coming in at 0.39, which does rank it relatively low. It ranks it lower than all the other purple tagged companies on the left here, which are the companies that I currently have positions in. So yeah, it's literally ranked the lowest out of all of my currently held companies, though there's plenty of companies below it itself. And so yeah, like I said, I will probably be trimming it even more. But that's just the way it goes. Sometimes you make mistakes on companies, and Alibaba is one that I'm willing to recognize. I got over exuberant in it at the wrong time. I don't think it's a bad company. Like I said, I feel like you know, it was trading below those ranges a little bit ago. You could have maybe have made a decent investment in Alibaba not too long ago for a little bit of long term that wouldn't have had a good margin of safety. But at least at current present value price, you could have made a decent investment. Assuming that would assume discount rates don't continue to climb back up, though, because that would bring the valuation down even lower. But regardless, that's going to basically be it for Alibaba. As I said at the start of the stream, we're kind of a little bit in limbo to try to decide what's going to be next for the channel. I did have BBWI on the docket and planned, and it still is ready to go. So that could very well be the next one we do, but I am also waiting for the 10K from Microsoft to come out, as well as the foreign annual report filing for Sandfire to come out. And I would take preference of those two over BBWI because one of them is obviously a huge American mega cap, and another one's one of my personal holdings. So we will be either way taking a look at those 3 companies in the near term future. One last cry before I sign off of the stream. Please like the stream. Please subscribe to the channel. Please join the Discord below. We'd love to chat with you. All right, I'll catch you all again next time. Bye.